I am an empirical asset pricer, which generally means that I look at data coming from the stock markets and try to find out, analyze patterns of behaviors that the stock market returns tell us. A lot of my research focuses on asymmetries in stock markets, so things like stock market crashes, downside risk. But if you look at behavior, investors care more about probability of losses more so than they care about gains. If you worry about the risk in the stock market, you should be focusing more on losses rather than gains. Another area that I looked at in terms of asymmetries are doing stock market crashes and how correlations disappear during bear markets. What that means is, precisely when you need diversification benefits, correlations tend to disappear, which means that when things go bad, everything tends to go bad together, meaning diversification benefits tend to disappear precisely when you need it. The interesting thing about research is that people tend to look at different markets separately. So they tend to look at the stock market separately from the bond market, separately from the currency market. One of my research is actually looking at the intersection between the currency markets and the bond market together. With recent news about tariffs and potential recession, it's going to affect both currency markets and bond markets together. This relationship is actually rather predictable if you look across different countries. So if you see that one country has a steeper yield curve than another, that tells you which bond markets you should be investing into. Another line of my research looks at mutual funds. So instead of thinking of mutual funds as investments, let's think of them as companies. If you're going to run a company or an organization, what's better? Should you have a bigger organization or a smaller organization? Because you can actually think of mutual funds as little laboratories of how should you organize your companies. My primary class is investment analysis and portfolio management. This is a class where you think about where you put your retirement money, or specifically where you might put other people's retirement money. When the price to earnings ratio tends to be high, you should avoid the stock market. Should you, move out of the stock market? If so, where would you go to? Would you go to the bond market? Would you go to the international markets? I tell them, hey, these are some parameters you should be looking at when you're deciding to figure out where to invest into. I used to do a lot of rock climbing. Being in Northern California, the premier place to go rock climbing is like El Capitan in Yosemite. I used to do this obscure activity called big wall solo climbing. It is not like Alex Honnold's free solo climbing, but big wall solo climbing is how do you get yourself and 150 pounds worth of equipment and food vertically up for a 7-day period on El Capitan. Nowadays, I'm too old, so I'm basically the old guy at the climbing gym, just sort of, showing the young kids what to do. We are GSM.